Stock futures, a little change to the downside this morning, but after putting in fresh records yesterday for the NASDAQ, we are crossing off boxes into 2024 that make bulls feel pretty darn good. Peter Andersen's felt pretty darn good. He's the founder of Andersen Capital Management. Told us last time you're having the best year of your career. And I suppose none of that's changed in the last month, Peter, with stocks still going up.
That is absolutely correct. So, we're counting down to the final days of this year, and fingers crossed, but still very optimistic about next year, too.
Your weather mark strategy up over 60% year to date. That's more than the NASDAQ, which is quite a feat because the NASDAQ's mega cap heavy pull has been a pretty tough bar to get past. Where did the extra juice come from this year?
Well, a lot of conviction. At this time last year, there were a lot of investors really trembling about the year and whether or not they were going to, if rates were going to kill the market, the rate hikes, that kind of thing, Oliver. And I just stayed pretty committed to my original holding. So I really didn't make a lot of changes over the year. And I am heavily focused on Nvidia, Supermicro, Palo Alto Networks, CyberArk. So these are stayed stocks that I have owned for several years, actually. And I just didn't change the course along the year, thinking that eventually the Fed would stop all this pain. And it looks like we are almost painless by the end of this year.
So you do view the macro pivot as being an important part of the upside here for some of those stocks?
Absolutely. But even if he were going to continue raising rates, one of the things I always ask myself is, are these companies viable companies? Will they be killed by higher rates? In contrast to, say, a mortgage origination company, and even when rates are increasing the way they have, these companies still have the robustness to propagate their business in a very positive way.
Yeah, okay. So cyber trades, tech secular stories, sounds like the safest place to be is go where there is a sort of natural growth that is not dependent on the Fed, but maybe doesn't hurt valuations also if the backdrop is more accommodative.
Yes, and I joke with some of my colleagues saying, can you imagine in the boardroom of, say, Nvidia or Palo Alto, if they spend any time discussing the Fed's actions and how they should react to the Fed's latest statement? I would venture to guess they don't. They're more concerned about keeping their heads down and focusing on their own business. So these are companies where if interest rates actually, let me just say to make this a point, even if rates were to increase maybe twice as much, I'm not certain the boardroom would be that concerned other than talking about the headlines of the day while they're getting their coffee, waiting to actually get down to business on their agendas.
Okay. So then as we go into next year, how do you build a portfolio that is not rate dependent, but also can acknowledge, if things go as planned right now, we'll probably have a little better of a, liquidity situation generally for markets, a little less onerous for companies dealing with debt, et cetera.
Yeah, so I'm going to use that famous word now, pivot. We've all gotten used to this past year, but I am going to pivot a bit saying this, that because I believe the Fed has stopped raising rates, that will provide an enormous boost for almost all growth stocks, I believe, because most people have been terrified of venturing into growth stocks in a rising rate environment. I am an exception. I never actually concerned myself that much about the rising rates in growth stocks. But given that that's kind of the general groupthink out there, what I'm hypothesizing is next year, a lot of money on the sidelines. We've got tons of money in money market funds I think they will be reading the tea leaves that, oh, the Fed has stopped raising rates. That's a good thing for the economy. It does look like we're going to have the so-called perfect soft landing, and they will start jumping in. So the technicals of this market will be very favorable for almost all growth stocks.
Okay. So the growth theme is what you still want to go for. How is it high conviction again, or do you balance it? Do you insert some stuff that is more kind of cyclical, safety style, or is that something you add in if the macro doesn't go the way you want?
I believe so. So, you know, I'm not all growth stocks, growth tech stocks. So currently I own a company called Coty Cosmetics, which is as far away from tech as you can get, right? That's a colored cosmetic company. But it has a very attractive turnaround story. So I love stories like that. It's just they're hard to find right now. Companies that have said, look, we've made mistakes. We've over-levered our balance sheet. Now we have found religion. We're going to stick to our knitting, go back to what we think we do best, and start to de-lever. And that really attracts me, because once you get the leverage off the balance sheet and you have more sober management, that's a true turnaround story. The sad fact is, these days, it's very hard to find classic turnaround stories, but that's one that I'm holding now, and predicting that next year will be a very strong performer.
Okay. Peter, any wild cards to be aware of? Any risk points?
Of course, yeah, there's always wild cards. If there weren't, you know, this business would be very easy to do. So artificial intelligence, you know, that is probably the most searched, one of the most searched words, I think, on Google this past year. It is so misunderstood, Oliver. I mean, I don't mean to sound arrogant, but I have spent a lot of time doing deep dives in the science of AI, and I will tell you this, that the theorists, the ones that are quietly laboring in the universities, trying to discover how the human brain works, they are the ones leading this charge, not the experimentalists, not the ones that are doing Project Gemini, for instance, at Google, which I have a lot to say about that, but maybe we should talk about that later on. But there is a lot of misunderstandings about where we are in artificial intelligence. I think most people think we are much further ahead than we actually are, and we have a lot to learn. So that misunderstanding might be a wild card, but I think it will be a wild card on the positive side, because cynically I'm saying this: if people think we're so far ahead in AI, and I don't think we are, that means that there's going to be a lot more computational power thrown at discovering perfect AI, and I'm going to ride that wagon all the way through 2024 and probably beyond.
Microsoft, Alphabet, Nvidia, is next year the transition maybe from hardware over to software? Or do you stick with those hardware names?
Well, I try to buy, you know, the manufacturers of the pick and shovel, so to speak, rather than trying to find the actual gold miner. So all those companies you mentioned are companies that do business with Nvidia and Supermicro computers. They're the ones that are building the picks and shovels for this great gold rush that has years, I think, years before we actually find, we might not even find out how the human brain works, but that is the key. You know, I say to people this: if we don't understand how the human brain works, how can we be expected to build a model of the way the human brain works? So we've got a lot of work to do, but Nvidia is leading the charge on all that research, and I would say stick with that name until we have a major breakthrough in artificial intelligence, and I don't see that anywhere in the future, frankly.
Okay. So this point still, the picks and the shovels, not necessarily the big product or service providers that are going to, you know, bring in major new products and stuff.
Absolutely. I mean, let me just give you an example. So when Google last week, I believe it was, came out with a short video of how their Project Gemini was improving, they actually had an example where that computer could so-called interpret mimes,
right,
you know, when you're playing charades. And that is the gold standard of artificial intelligence. I don't think a lot of people realize this, but computers cannot do that. A computer cannot read a human's actions and interpret it in the classic game of charades. When I saw that video and I saw that it had interpreted a mime, I thought either they had made a tremendous breakthrough or they were exaggerating the research. And unfortunately, it was the latter. They have not discovered a way for a computer to read mimes. So that shows you, the reason I'm telling you that is that shows you the competitive nature of these players, that they will actually push the level of honesty just to get out there. And if you recall, Google's stock moved up about 6 or 7% based on that, which I would say is at best a stretch of the truth.
I like that. It's a good assessment, I think, of how that whole situation went down. Definitely speaks to the intense competition, the need for these companies. You know, it's a signal that they've got something to stay ahead of their peers. Peter, appreciate the conversations over the year, and we'll chat with you in 2024. Thanks a lot.
You're welcome.
Peter Andersen, founder at Andersen Capital Management. All right, sticking the course with the heavy tech portfolio, but mixing in some other stuff too, still with the focus on growth companies and AI, cyber stocks that have done so well this year.